So this is weekly commentary 55. Now from the previous weekly commentary, we expected if we go to the 4 hour time frame, because that was the emphasis, right? We wanted to see this buy side liquidity pool get tagged, and we did go and tag that. Now for the next week, right? I want you guys to have this range that I have with my fib, right? From this low, right? If I just make that a bit neater, to this high, right? Now it's likely that we're going to offer a rejection from this monthly, this volume imbalance, right? Now for the next week, I'm expecting a retracement at least to the 50% area here. What I want you guys to monitor is this, right? You see from here to here, this candle, right? Watch that. This is a redelivered rebalance. You see this wick of this candle. It overshoots this body entirely, right? When we see that, right, that candle, and then the body, remains inside of that candle's wick, forget this wick exists. Just focus on this candle's close and this candle's low. There's a fair value gap within there. That's a redelivered rebalance, right? Now, this is resting near the 50% level, right? Also, remember this reclaimed fair value gap from this candle's low to this candle's high. I don't want to put it on because it's going to be, too much clutter on the chart, but just consider these things, right? I'm watching the retracement back to the 50% of this range. Now, for the US 10-year, I understand there was a large move down on Friday, right? Now, we have CPI, right? If you go and understand the economic calendar, now, daylight saving time, right? For America, the kill zones are going to shift an hour back for the UK guys, right? Until it changes for us in the UK. And then it's going to be back to normal. Monday, is there any significant news driver? No. Tuesday, now look at Tuesday. I want you guys to see how I see it. We have this, right? This is essentially the employment numbers for the UK, the claimant count change. That's at 7 a.m. This is all in UK time for now, right? And then at 12:30 p.m. UK time, what do we have? We have CPI for the US economy. Now, when we have just one day, when we have a day with just one, you know, specific time, an area of time where we have, clear likelihood of manipulation, it's quite easy to frame your trade, right? Now, when we have two, it it's a curveball, right? Because we know that there's going to be, significant swing at this time of day, significant swing at this time of day. So exercise a lot of caution going into it. You want to see this and really please understand this, and I've repeated this a lot of times because this is essentially the crux of power of three. Every single candle is a power of three open, high, low, close. The guys that have finished chapter 6, you know exactly what I'm talking about. If you haven't, you'll get to chapter 6 and you'll understand. Don't rush there because you need everything else, right, for chapter 6 to really, make sense to you. Every single candle is from its open, high, low, close is a level of power of three. I'll give you a quick example. Bullish candle, the open to the low, right, is going to be the manipulation. And from the open, so the Asian range to midnight, we want to see kind of consolidate. So the consolidation near the open of the candle, the open to the low is the manipulation, and then the low to the high, the expansion, is going to be the distribution phase. Now, what you have to do every single day, and this is what I want you guys to really focus on. Maybe have this on a note, on a piece of paper, and keep this at your trading desk, or just put this somewhere where you are always gonna, you know, see, so you can reinforce it and it can really, be engraved into your brain. What phase of the power of three model are you in for the day and for the week? Has the manipulation been done for the week already, and now you're in the distribution phase? So then you know what side of the expansion of the weekly candle are you likely to you should be entertaining. Now for your daily bias, right? When you're in the day, let's say you're bullish, you have to understand, are you in the manipulation or distribution factor of the power of three model? Because now let's say this, right? Let's say that after this news event, it was a clear manipulation and you're in the distribution phase. And it's going pretty slow now, right? Let's say it manipulated and it's just consolidating for the buildup of CPI. This, right, this is going to be the main driver of the day, right? Pound's going to drive this, definitely. It's going to have a move of this. This is going to be the main driver for the start of the week. Monday, no, there's no economic driver. We can expect Tuesday, right, to have a greater tendency to place in the opposing end of the range over Monday because this is greater manipulation. I'll give an example. Let's say the DXY. We're expecting the DXY to trade to the 50% of the range. Let's say this Monday gets us close to the 50% of the range and Tuesday's candle opens, close to Monday's low, right? Tuesday, more likely than not, well, very much more likely than not, will take Monday's low. Why? Because it has a manipulation factor inside of it, being the news events, right? Now, going back to what I was saying, let's say the manipulation factor was, completed and it was clear to you, right, with this news event. Then you know what day, what part of the Power 3 model you're left in for the day. There's distribution left, right? That's what this folder is likely to do. You're always framing everything with the lens of power of 3. Always. Accumulation, manipulation, distribution. You just gotta know what phase of, you're in within the day. Let me give you an example. Now, what I've just told you guys, apply that to how I've taught you guys to trade in New York. It's either a continuation or a reversal. Now, we can have manipulation from midnight's open all the way until in New York. We can have that delayed protraction. Usually going to set up a nice market maker model for, the rest of New York and London close. You have to know whether you're going to be inside the manipulation or distribution phase of the day, right? Then you can frame your trades better, right? So just bear that in mind. Now for Tuesday, we have these news events. Wednesday, again, you see Wednesday, the times, it's only this one specific time. And you see how this is much easier to understand where you will be in the phase of accumulation, manipulation, distribution, because there's one specific time of day where there's going to be a lot of kick. You just need to know where you are before the kick occurs, right? That's how you can essentially place yourself in line with a high impact news driver. If you can, sieve out, is it likely to be manipulation or distribution, then you can set yourself up to align yourself with the news driver. Unemployment claims, give great respect to the unemployment claims. And Friday, we have the consumer sentiment. So you can see that this week has quite a lot of drivers, right? Now, this one is going to be the main one of the week. Now, from many weekly commentaries ago, right? Actually, before we touch on that, CPI, this is what we're considering. If you consider this low to this high, right? 50% of the range we want to come back into. Now, consider this fair value gap from here to here, also this volume imbalance, right? We can dig into that. It will be pretty much optimal trade entry of this range. Now, why is this significant? We had sell stops resting beneath here, fair value gap here as well, right? What happened is we ran sell stops and look at that displacement away, right? Ran sell stops, displacement away, we broke the high. When we break this high, we expect retracement at least to the 50% of the range, right? Don't be thrown off by this big down candle. That's totally fine. That's totally normal, right? Sell stops taken, high broken. That's displacement, right? Look at the up candles, the displacement away. We expect retracement to go higher. The overall narrative for the US economy is this, right? There's still inflationary pressure. And they're becoming more hawkish on the rates, right? From many weekly commentaries ago, we said that, I'm talking January times. We said that what? They're going to make it look like inflation is under control and they're going to say we can do a 25 BPS. And that's exactly what happened in February, right? That's exactly what happened. And then what happened? They see that inflation is creeping back and they're going to say, okay, we need to actually be more hawkish on the rates. And that sets up a Judas swing for the start of the year, which was into the monthly fair value gap for the DXY. And now they want to be more hawkish on the rates, which is going to be bullish for the yield. And the bullishness in the yield spills over to bullishness for the DXY, right? I recommend letting Tuesday and Monday pass. If you can find perhaps, a scalp in Monday, because, there's no big news driver, fair enough. Now, why do I say scalp and not holding for the whole day's range? You need to understand what the day is likely to be. Is Monday likely to be expansionary on the range, or is it likely to be, you know, a small range day? By just looking at your economic calendar, you can tell it's probably going to be a smaller range day, right? Now, for a smaller range day where you're not expecting expansion of the range for the week, you don't look for holding for external range and, holding for large range trades on your, 50 pip moves on Euro USD or whatnot. On the days that are likely to expand, which is going to be your Wednesday and Thursday for this week, definitely. Those are the ones where you can try and leave runners on the table. Other than that, look for scalp because you know that there's going to be no, you know, considerable expansion that's going to be offered in the marketplace. Now, if we go to the DXY and we go to the daily chart, volume imbalance left, and we had these relatively equal lows and we took that. Now, we're still closed relatively close into this fair value gap. And this is why I say it's stuck in between a rock and a hard place. We've taken buy stops above these highs and this high, and we've taken a sell stops here. Now we're in the middle. Let the Monday and Tuesday pass, right? Because yeah, we took sell stops and we kind of come back into this fair value gap, the closure of it. If you see Monday early on London trades down lower, creates a distinct low of the day, and has a significant displacement, you can perhaps get back to the 50% of this candle's range, right? But when you're looking at the chart and you're saying, okay, I can be long and short here on the daily, this is where you want to sit out. This is where you don't want to be a participant because essentially, if you could be long and short, you're neutral, you're flat, you don't know which side is likely to be favored. And it's way better to always try and trade in line with a clear bias, right? So let the Monday and Tuesday pass, and you'll see where the expansions are likely to be, right? Watch this area be traded down into, right? Even here, you know, it's still quite relatively equal. Even though we ran these sell stops, right? We can still run this area one more time. Now, what's going on with the actual, current affair with the Silicon Valley Bank? That bank has essentially went down, and a lot of funds, were in that bank. In 2008, something similar happened, and that offset, the recession of 2008. Now, is it gonna be something similar? I don't think they'll do something exactly the same. It's too obvious, oh, this is just what happened in 2008. It's a very unsteady time period right now for what's going on. Now, match it with the technical. The DXY is in a sticky scenario. I'd rather wait for one clear side to be offered. This is where patience pays the trader. Because touching on patience paying the trader, and I had this on my Snapchat story for you guys to watch, right? I said something, and I said this, and it makes a lot of sense. And some of you need to consider this. If you can reduce your losses in trading, you're increasing your profitability. Every single business has a cost of operating. Simple. Every single business in this world has a cost, right? The cost to us traders is our losses, right? Now, if we can make our losses, losses that are just incurred from the trading system, which is totally fine. Every trading system incurs a loss. That's fine. But when you take a loss that is out of either, you know, a human error on your part, human error being, you fell victim to your emotions or revenge trading or trading in a scenario where you shouldn't have. Those are inefficient losses, and you can definitely remove them from the system because that's not the system incurring the loss. That's you as the executor, forced, making the loss incur for your system. If you can remove those losses, then your cost of trading goes down, and your profitability should increase, right? So consider that. Now, if we go to this is the one that you're all asking me. This low here, in here, is a breaker block. We ran the highs and we displaced lower. Watch the move back to this candle's low, right? And it matches with the 50% of this candle's range. Watch this and watch for any displacement away from here, especially if you can line it up with CPI and the CPI drops it from there. You know, I'd expect this low, essentially a market maker sell model. If you go to the daily time frame, right? Accumulation, consolidation, again, leg higher, and that 3 month institutional order flow entry drill, that's the higher time frame context of it for the smart money reversal, and that's the confirmation. If we go up into this low and displace away, watch the run to these lows, right? Now, with the market maker models, we expect to be a new low. Now, what did I just do? This is from weekly commentary 9, right? When we run any level of stops and we have a clear market structure shift and it's all inside of the high time frame PD array, it has to be from a PD array. This doesn't make sense if it's not in line with the PD array. That is just a pattern and we're looking for it to be at a high time frame PD array. When we get this, we can use the deviations to see where the expansion and the algorithm is looking to reprice. When we're in a market maker model, we expect the new low of a market maker sell model or the new high of a market maker buy model to exceed that of its initial consolidation. Now 2 comes back to the initial consolidation and 3 makes a new low, but so does 4. But let's work with 3 first, right? Let's not just jump the gun to 4. 13.5, and I said this to you guys, watch that level. Given we disrespect, we move here and move lower, I have my eye on 13.5. I expect it to be at least a swing point made in, a new low being made at 13.5. It can definitely trade lower than that. This the one as well, right? Because the high time frame narrative for the DXY is bullish. Likewise for the bonds. Likewise, they're hawkish on the rates. So this is how you have to think of it. For Euro, again, you see, we ran sell stops and we ran buy stops, and it's back in the middle. This is where you want to exercise caution. Where is it? Look, it's consolidating, right? Pound, ran stops, and we're back down here. Just wait for one clear side to be favored. Have this fair value gap marked out still. Now, if you look at to Euro GBP, right? This is a run on stops. You see here, if you just ignore the wicks, right? You see how we run up higher into here and we displace away? That's a run on stops because the majority of orders, they rest in the body of the candle, not the wick. The wick is unreliable data in saying that the wick, the orders in the wick are not significant. You see when we see a run up, the body candles, it's not if it wicks into a wick area, it's if the bodied candle runs into the wick and displaces away. That's a run, count that as a run on stops. Now have your eye to this low. This low is very close. This low, have your eye there. For the S&P, institutional order flow entry drill, right? High, right? Ran stops. This high to this low. This candle wicked it, 50% sweet spot, right? And that displacement away. Where do we expect what do we expect the market to do after an institutional order flow entry drill? To expand to the opposing side's liquidity, right? Mark this low, 376362, right? 3763.2 from the low here, right? Mark the low of here. That will be my draw on liquidity personally for the S&P 500, right? Now, that's going to be it for this weekly commentary. Please understand the start of this weekly commentary when I was talking on the Forex Factory Canada with the Power 3 on framing and understanding where you are in terms of the daily expansion and weekly expansion, what phase of the Power 3 model you're in, and that's a gold mine. If you can do this right, you see, I'll give you an example. Let's say this happens, right? If you can split your monitor, or if you have a multiple monitor setup, if you can have the asset class you're watching on a daily chart on one of them and just a 15-minute chart or 5-minute chart on another one, and you're just looking at that daily candle and you're focusing that daily candle, and you know that your bias is going to be predominantly bearish or bullish going into that day, watch the screen with the daily candle. When you see, and you're bearish for the S&P at around this time, right? When you see that candle move into this wick, and you have the 5-minute and the daily here, you understand that the daily is in the PD array. Now, if you're seeing on the 5-minute chart, the other monitor that you're seeing clear displacement, market structure shift, you know that this is probably going to be the opposing end of the range. That's the benefit of having a multi-monitor setup. Now, when you understand, because then what you understand that of the daily candle, what phase finished, manipulation, what can you expect? Distribution. Does the price level that it's at and the time of day make sense for distribution to occur as well? Is it a high probability time of day kill zone at a high probability area being a PD array? Then you're just on the hunt. If you can set your monitor up like that, you know, do it. Get used to it. I do it personally, right? So that's going to be it for this weekly commentary. Remember, exercise caution, right? There's many people saying that we're going to expect a flash crash or whatnot. See how Monday opens, right? But the way when Monday opens, I want to see if we're gapped anywhere. If we're gapped on the S&P or if we're gapped on the DXY, right? I want to see if we're gapped, right? Let the Tuesday pass. Let CPI fall over and hunt the 3 remaining days: Wednesday, Thursday, Friday, right? So that's going to be it for this weekly commentary. Until next time, and I'll see you guys in the next one.